Welcome to Sectors Up Close. I'm Elena Casas. Our topic today is luxury retail, and my guest is Sweta Ramachandran of Artemis Fund Managers. Investing in luxury retail used to be a one-way bet, but this year it's been more a tale of haves and have-nots. Recent sales updates from Europe's biggest luxury brands did little to give reassurance that Chinese demand for high-end fashion is recovering. Gucci owner Kering and others warned of low demand in Asia, and while industry bellwether LVMH and beauty giant L'Oreal helped bolster confidence, they didn't dispel concerns about Chinese appetite for premium goods in the wider sector. To complicate things for investors, share prices of these household names have varied wildly. Kering is off nearly 20% year-to-date. Cartier owner Richemont is up about 25%. But LVMH has barely moved this year after more than doubling in price between January 2020 and April 2023. So, how should investors tackle this sector? Let's ask Artemis Fund Managers Sweta Ramachandran. Sweta, in your notes you said that after 2 years of stratospheric growth in this sector, a rising tide no longer lifts all boats. So what's happening here?
Thank you very much for having me on. Yeah, absolutely. The point that we want to make is that we're no longer looking at the sector from a top-down basis, but at companies from a bottom-up basis. So here, the divergence in fundamentals between the different companies in the sector is leading to a very significant dispersion in share price returns as well. And as active stock pickers, that's really what we like to see.
We've heard an enormous amount, Sweta, in the last year or so about slowing demand in China and the impact that that's having on the luxury sector. Is Chinese demand starting to return now?
So I think what the distinction that we clearly need to make is the difference between demand in China and demand with Chinese nationals. Because what was taking place pre-pandemic was that 70% of what Chinese nationals were spending on luxury goods was taking place outside mainland China. Now, obviously, with the lockdowns and the abrupt end of outbound travel from China with the pandemic, all of that spend was repatriated back home. Now the Chinese nationals are traveling again. Again, it is making its way outward again. So this is again leading to very different results by company and by geography. For example, spend with Chinese nationals in Japan is booming thanks to the cheap yen and of course the duty-free shopping regime there as well, while spend in mainland China is seeing challenges because of the return of outbound Chinese tourism.
We've seen some enormous rises in margins in this sector, particularly at LVMH, where we've seen some very high markups on leather goods and handbags and so on. You did say that the companies are running out of space to keep increasing prices. Where do they need to go from here?
Yeah, so this is, I think, a situation that benefits stronger brands versus weaker brands is that the situation of pricing power that we saw pretty much indiscriminately, all luxury brands took up prices by 20–30% in the last 2–3 years. That is now returning to becoming the preserve of very few companies, which is what I call pricing privilege rather than pricing power. So here, it really comes down to it's a function of brand desirability and momentum and heat. These are the companies that are going to be able to take prices more than others. And I think companies that have been a bit more measured in terms of their own price increases, I would put Richemont's jewelry brands in that category, brands like Prada as well, which have been a little more measured versus peers. These are brands that are actually outperforming others at the moment.
So if this is a stock picker's market now, who's benefiting the most in the new environment?
I think the two buckets that I would look for are companies with very strong desirability and brand heat. At the moment, that is Prada is certainly a beneficiary of that. Moncler is also benefiting, although a highly seasonal category given its exposure to down jackets. And then I think there are the bellwethers, which are exposed to a much more resilient, high-income consumer. Hermes would be an example, Brunello Cucinelli. I would put Ferrari in here as well as the ultimate arbiter of, inelastic luxury demand. And these are companies that are also withstanding the current slowdown, which is most acute among the aspirational consumer, the best.
Let's talk about the market bellwether LVMH here, which stock has flatlined for this year to date after rising enormously over the last 3 years. Is that a good pick at the moment in your view?
I think the reason LVMH has flatlined, as you put it, for the moment, is that its growth is normalizing. So it delivered 2% growth in the first quarter of the year for its key fashion and leather goods division, compared to, let's say, Prada doing 17%. And so that kind of is a function of obviously the law of large numbers. Given the Louis Vuitton brand today is a 24 billion euro brand, certainly with a longer term view, with a 2 to 3 year view, we absolutely see LVMH as a winner in a sector which is characterized by this increasing polarization between winners with scale and losers without.
Some of the names you mentioned there have a very high price to earnings ratio at the moment. Hermes, for example, is at 53 times current earnings. Is it still a good choice at that level?
So I think the PE multiple for Hermes has always been high, and you're right, it is trading at the higher end of even its historical range at the moment. But the market sees this as somewhat of an ultra defensive name, so its valuation is somewhat disconnected from other names because it is not exposed to the same amount of demand fluctuation as other names are because of its supply-led business model.
Sweta Ramachandran of Artemis Fund Managers, thank you so much for that analysis. Well, that's your roundup of the luxury goods sector. I'm Elena Casas, and this is Reuters.